Is continue with technical analysis. The first one is with gaps. We have a lot of types of gaps. Here is an example, and sometimes we call this a common gap. There are very many different types of gaps. So let's scroll down further. So what is a gap? A gap is a case where the low of the next day is higher than the high of the previous day. In other words, there is a zone here between two consecutive days, and that zone has no trading in between these 2 days. Here's another example. It is a perfectly common sense concept. Next thing to understand is the concept for a gap called filling the gap. You fill the gap when once you open up the gap, the price behavior starts to drift down back to the level where the gap opened up. So over here, the gap opened up and it went up here, so it covered back, it filled the gap, and then it continued on its way up. A gap is typically a continuation pattern with usually 1 or 2 exceptions. So if it gapped up, that's how we call when the gap is on the upside, we call it gap up. Then you'd usually expect after filling the gap to move up again in another uptrend. Now, you have a second gap here, much bigger, much more powerful. You have a fairly lengthy filling of the gap, and then it moves up further higher. So, what you got to understand that usually, and they give some statistics, anywhere between 70 and 80% of the time, the gap gets filled, and if that's the case, then you usually expect a continuation of the trend. Let's scroll down. Alright, so one classical example of a gap is a breakaway gap. Let's scroll just a little bit more. On a breakaway gap, you see that you have certain support levels over here, and suddenly it breaks down, and then there is no filling whatsoever, but it continues. Usually, for a gap to be a valid, there is one major requirement. The requirement is excessive volume, or a volume which is substantially larger than the average volume. How do we know? On charting technology, you can see the blue line here represents 60-day moving average of the volume. So this is 60-day moving average volume. What it means it takes the last 60 days and it averages out the volume over the last 60 days, and then you have many times over. Here you had roughly 5 million, and here you had almost 20 million. So the volume here is 4 times larger than the average, at least for the last 60 days, for the last 60 trading days. So the bigger the spike in volume, the more significant the gap. If it gaps up without a major volume, you have to be careful. Maybe this is not a significant technical indicator. Let's scroll down any further. Alright, so another example here is, and that's very typical, you'll have some sort of a formation. I just mentioned a couple of lectures ago at the very beginning about triangles, but I never really explained them. Well, here's an example of a triangle. This triangle is called an ascending triangle. An ascending triangle will have a horizontal top and an ascending bottom. It will be moving inside this triangle, and ultimately it's going to break out of the triangle. When you have an ascending triangle, typically it signifies a continuation pattern. If it signifies a continuation pattern, it means it's coming from below, it enters this ascending triangle, usually when you're coming from below, moving uptrend, you're getting into an ascending triangle. This is a classical example of a consolidation. So, an uptrend, consolidation, and suddenly out of such a consolidation, typically the breakout is in the same direction, meaning a continuation pattern. No volume to tell us here, but you get yourself again a breakaway gap. Usually a technician will wait for a day or two, and somewhere in here will take a position and hopefully profit out of it. Let's move on and see. Alright, so besides breakaway, you also have runaway gaps. I really don't know most of the difference between the two, but visually what you see is suddenly it keeps moving and moving and moving, powering higher and higher. There is very little filling back. Essentially the gap is never ever filled, and then it continues. Again, what you see here is one major spike in the volume, and this second spike here would correspond to this top bar over there. This indicates an exhaustion. So, what it means is a lot of buyers came in here, then they saw the price moving up, then the second major spike in volume indicates that there has been an exhaustion of buyers. All buyers got in. So once you see the second spike in volume, it tells you that you're up for consolidation. Probably where volume lowers here or lowers there, the consolidation is good. So in these low volumes, it is a good entry point. So what I'm making another point here, fundamental to technical analysis, that some technicians like to follow only the price. Much more sophisticated technicians definitely watch volume in concert with the price. They think of volume as yet another indicator that will confirm or put doubt into your hypothesis. So, what a technician does is he works with a hypothesis. He works that this is a runaway gap. He also works with a hypothesis that this has been a major bottom. The bottom hypothesis is confirmed by major volume in here. In other words, you see volume here is 2 or 3 times higher for many days, more than 2 trading weeks, roughly 10 trading days. So once volume spikes and spikes for 2 weeks, this means what is called in technical analysis that the stock has gotten from weak hands into strong hands. Weak hands are hands that are shaken out of their stock easy. These are people who are not confident in the stock and they are selling out because they don't have confidence, or maybe they get margined out. What is to margin out? It simply means that as the stock goes down and down and down, they get margin calls. As they get margin calls, they put up some money. In other words, they meet the margin, then the stock goes down further, they meet the margin again, and the stock goes down so much further that they cannot put up a margin anymore, and their account, meaning their position, gets liquidated. So usually in a long downtrend, you will see the reversal of a major downtrend, usually a cyclical downtrend, with a major rise in volume associated with a shakeout of the weak hands and a transfer in strong hands. So once it's in strong hands, volume goes down, but the stock begins to drift higher. The hypothesis here is that once the shift from weak hand to strong hands has occurred, you'll actually get this breakaway on a huge volume, and you know the run is on. In other words, the bull market is on and you can take safely positions. Alright, let's move any further and see what we got here. Alright, what we have here is a classical example of an exhaustion gap. An exhaustion gap occurs when the stock gaps up much higher. It could be possibly to gap down a lot lower. And then on the next day you have this engulfing formation, and the engulfing formation covers completely the gap, and get this, on a very high volume. So what is the meaning of exhaustion? The meaning of exhaustion in technical analysis indicates that as the stock has been going up and up and up and up, and people have been watching it and trying and waiting for a pullback, the pullback never came. So on that exhaustion day, they bought in desperation just to get in. So these are the guys who are behind the curve, and these are the so-called dumb money. They ultimately see price went up from 55 all the way to 70, and they've been watching it all the way, and finally in desperation they bought in at 70. Well, this means an exhaustion. It means that it's suddenly everyone who's been buying has bought, and on this spike everyone else that was still watching to buy, suddenly in desperation, we call it in greed, they jumped and bought. Well, when they bought, we exhausted the buyers. When we exhaust the buyers, remember, buyers have been exhausted for quite some time. This is the last exhaustion with a gap. No one's left to buy. When no one's left to buy, stock falls out of its own weight. Alright, let's move down. Alright, let's close this tab and move on to the next one. Alright, so momentum studies is associated with two measures, MACD and relative strength indicators. So here they talk about relative strength indicator, sometimes known as relative strength index. So RSI is how it's known everywhere in the world of technicians. So RSI indicators usually are normalized between 0 and 100, and usually once they drop below a certain meaningful level, around 30 or 25-30 zone, it indicates an oversold condition. Let's scroll a little further, and at the same time, once it goes up above 75 or 80, it indicates an overbought condition. So you saw these there. Let's scroll down any further, see what we have here. Well, we need some more. All right. So now is a major concept in technical analysis, the concept of divergence. Concept of divergence is associated with two series. It could be two different prices, or it could be a price and some sort of relative indicator. The divergence is the blue line up there, which points upwards, and the red line down here, which points downwards. So, as the one keeps going higher and higher, this one here underneath, or the second series, could be a price series, should be confirming. Confirming means if the first one is making higher highs, this one should be making higher highs. So you have a low, you have a high, now I have a pullback, you have a higher high. Higher high means that this high is higher than this one. This represents a higher high relative to this one. Now you have a low here, then you have a high. This high is not higher than this high. We call this a lower high. In other words, this is a high lower than the previous high. This one here is a lower high. This is a high, but it is lower than here. So over there you have higher highs, and over here you have lower highs. This is divergence, and divergence puts doubt in a trend. A divergence indicates that the trend is most likely close to its end, that the trend is at risk, and that if you have a position, one of two things. If you want to be really safe, you get out of your position, or if you see some breakdown or some other indicator of a trend reversal, it will confirm this divergence. So that's how it works. Let's scroll down and see what else we have here. Alright, so these are sometimes also called the RSI, sometimes they have also a name of a stochastic. So this is a stochastic with 9 and 3. The general idea here is that you have two lines moving up and down. So this indicates a local high. This is called overbought condition. And if the stochastic is short in time, you get a short-term overbought. So this represents a short-term overbought. Here it is. This represents a short-term overbought. Here it is again. This one represents yet another short-term overbought. Here it is again, and once again over there, and once again over here. So, usually this is a good indicator for short-term traders or intermediate-term traders that are trying to trade in and out of intermediate trends. And you get into overbought condition, you might as well sell. You get into this one here is called oversold condition, you might buy. So this one here would be a nice buy position, and you can get in for 10-15 days of trading and sell out in the overbought condition. So from oversold to overbought, this is what they tell you is called a stochastic sell. Stochastic sell occurs when you have two things. Number one, you're into an overbought territory, but the second, the tiny line, or actually the big line, goes underneath the thin line. So the black thick line goes underneath. In other words, not only you're in overbought condition, but the two lines cross. By the same token, over here at this point, you see the black thick line and then moving above the red line? In this case, you have a stochastic buy over here. I mean, you can look into many others, but this is a good example. So, this one, when you have two curves, usually when you get into the overbought or oversold condition, and the two curves shift or change their positions, then you have a stochastic buy or a stochastic sell. Alright, let's see what else. Alright, another nice indicator is the so-called MACD indicator. It is called Moving Average Convergence Divergence Indicator. Very popular. You can read some of the history. I've had difficulties in my first couple of months to learn it and understand it. But once you figure it out, it becomes very easy, very convenient, very helpful, and very powerful. Have a question?
Yes.
All right.
What are the black and red lines in the stochastic movement?
What is it? I can't understand.
The black and the red lines in the stochastic movement.
Okay.
What do they represent?
Well, they represent moving averages. So it represents a 12-day moving average, the one. The other one represents a 26-day moving average. So you have the one and you have the other, and usually the MACD will also be represented, you'll see, in a little bar which shows the difference between the two. So what this simply says is how far you're into oversold or possibly overbought condition, but it also shows you this same classical divergence from before. So they use different variations over here. This one is good for intermediate and also for long-term trends where you can see is it going up or is it going down. Let's scroll down. Well, nothing down. Let's move on to the next chart. Alright, so let's scroll up. What's this title here? Alright, so this is Trendlines. So Trendlines, if you remember, I explained very early on and I promised to show you some examples, is when you're in an upward move, the trend line you draw from underneath. So in an uptrend, you must draw from underneath. So you have a major trend line, and this one here is sometimes called supporting trend line, or sometimes a fan. So this one indicates major support. and this one here indicates minor support. So what you may get is from over here, correcting from the minor support back to the major support, and you're still going to be in your uptrend. So the uptrend is considered to be over, or it's what's called violated, only when the stock falls underneath in a meaningful manner. Meaningful manner means a couple of things. It means more than 2 or 3%. Some technicians demand at least 5% below the trend line. And the second meaningful indicator is usually a fairly decent volume. In other words, you got a trend line, it's got to drop underneath significantly and on a significant volume. If this occurs, you got to watch out, because the uptrend might be over and you might be getting into a reversal. Also, you're going to be watching for some other reversal patterns like head and shoulders or something else. So let's scroll down any further and see. Alright, so what you have here, that's the example in the opposite direction. You got a downtrend. The requirement is that you must draw it at the highs. So the uptrend, you connect the lows. On a downtrend, you connect the highs over here. And here you have a breakout from the downtrend. When you have a breakout from the downtrend is likely violated. The downtrend is likely over and you're likely in a reversal. I found, as far as I'm concerned, simple downtrends like this to be phenomenally helpful in analyzing and understanding things and looking into it. Usually, if it comes here and somehow it breaks the trend line, but then it gets back, I'm going to be talking sometime later, we call it a false indicator. In other words, you get a false signal and the signal doesn't come back. I don't want to get into this now. So let's scroll down any further on downtrends. Alright, let's see what else. Alright, one of the important considerations to have in trend lines is that once you have a sufficiently long period of time and sufficient range, like here from 5 to 50, a trend line is much, much better when it's done on a log chart. Back in the old days, meaning 50, 70, 100 years ago, log scales were a luxury, but now the general rule of thumb is very simple. Anytime possible, you simply use a log scale here, and log scale is by all means the preferred scale rather than the linear one. So let's scroll down further. Alright, so now you see, if you're not in log, see this is the same chart here. Over there in a log and over here in a linear. See, these are identical. You see how you have the one trend line, then the second trend line, then the third trend line. Usually trend lines don't draw well or nicely or appropriately on a regular linear scale. They draw nicely on a log because the log indicates growth rates. Alright, let's scroll down and see what we got in here. Alright, so you got here semi-log scale. You see what it is? Arithmetic. So here's another one. What I call linear is also known as arithmetic. So you have a nice, beautiful downtrend, but you see that the trend line kind of doesn't look nice or right. So you're simply better off using the log. Let's see what else we have here. Validation. Alright, so this is a valid trend line. When the price goes through in a significant way, it is called either a breakdown or it's called penetration. Penetration. It's also called violation. So these are typical terms that technicians will use. When you listen to something that tell you, oh, okay, the trend line hasn't been penetrated or hasn't been violated. Alright, so this is what is called a valid trend line. Usually has a number of points. trend line is relatively more valid the broader the base over here. The base means that you have from March to June, you have 3 months, and 3 months constitutes a fairly broad base for two lows to have a fairly valid trend line. Here you have a confirmation like 6 months later. So from June to November, 5.5 months, that considers another validation of the trend line. Over here at point 4 in March, which is already, you can see, a year and a half later, you have yet another validation of the trend line. So far the trend line here is valid. As long as the trend line is valid, the uptrend, we also call it a bull trend, the bull trend is intact. Intact means that you believe that it is true, that it is still valid, and that is in force. Alright, let's scroll and see what else we got. Spacing of points. Alright, spacing of points is what I was basically explaining so far. 1 and 2 is very tiny spacing. We're talking basically less than 2 weeks. If you're talking basically less than 2 weeks, that spacing is not very significant. So the broader, meaning the wider the spacing, the more significant. So if you have this as 0.3, then 1 and 3 or 2 and 3 will provide a little more significance. Yet basically a month and a half is not too much. You need at least a couple of months of spacing between the points, meaning those here, support, resistance, or trend line points, in order to have some strength and validity of a trend line. Alright, so angles, well, sometimes the steepness is an indicator. Sometimes when it gets really steep, I mean, you got to understand, if it's super steep, it can't last for a long time. So the steeper it is, the more likely it is that it will not last a long time. I mean, you can't just expect it, to double in 3 months, and then double again in 3 months, and then double again in 3 months. The stock market doesn't reward like that. If it doubles in 3 months and then again in 3 months, in other words, it's up 4 times in 6 months, you're very likely going to get a major pullback, a major correction that will give back at least half of the gains. So the point is that the steeper the trend line, the shorter it is likely to be. Here you have it from September till February, roughly 5 months. Yeah, it may last for another 5 months, but you shouldn't bet on such a steep trend line. I mean, we're talking here, see, from 10 to 40, it practically doubles in less than 6 months. Sorry, quadruples in less than 6 months. So, price up 4 times. This means return of 300% in 6 months. It can't last for too long. It's too good to be true for too long. So you shouldn't be betting on this trend. It's not a reliable trend. Alright, let's scroll down any further. Alright, so what you get here is internal trend lines. I don't see these right now in here. Maybe they'll show up a little later. So, what this is indicating, a little penetration, no big deal, a little penetration. I don't know what this internal is trying to show me in here. Alright, this is what is an internal trend line. You have one big here, that's the blue one, and then you have the second one falling in here, a second. So, sometimes you have 1 or 2 or 3, and one will be the major trend line, and then you have a second and a third one, which will be internal trend line. So this one here might be considered an internal trend line. Let's scroll down further and see what we have. Well, conclusion, anything. Alright, so what do we have here? We have one support, second support, third support, fourth support. Now you see you have a breakout here. There's some resistance, which turns into a support. And here is something that could happen often. If you have a uptrend, the uptrend is violated, and the uptrend continues, the former uptrend, which was a support line from below, becomes a resistance from above. So this one here is bounded by the trend line. So again, violation of the trend line is not a strong or guaranteed indicator that the up move is up, but it is over and that it's going to reverse and fall. You expect it, but it is not necessary. So if this support holds, probably it's going to drift from underneath the former trend line. Alright, let's see. Well, next one. Alright, so I'm not going to discuss any of these. I have put it on the website for you what is a candlestick pattern dictionary. So it simply is a reference. You get a specific pattern, for example, abandoned baby, you look what it is, and it explains it to you. Then you have a dark cloud cover, you have a doji, you have downside Suki gap. Well, this sounds Japanese because it is Japanese. Candlesticks were developed in Japan originally. Most of these terms are of Japanese origin. The words have Japanese etymology. So, dragonfly doji, engulfing pattern. So, I'm not going to explain these for you. That will be one hell of a boring, unproductive lecture. But what I'm trying to tell you is, yes, it exists. They are on the website. You can find them also on the internet, this particular page. Anyone can download. You can read it on your own time. And you familiarize yourself so that when you hear technicians talk, you know what they're talking about. So, you can scroll a little down, you see a whole bunch more. Evening doji, evening star, falling three methods, gravestone doji, hanging man hammer, a whole bunch of them. Let's move on to the next one. Alright, so what you have here, and we're not going to go through this, is again, you're seeing this is coming out of stockcharts.com, one of the leading sites on the internet for technical analysis. You see chart pattern, and this is again a reference page. I have gotten through many of these, but I haven't gotten through all. So, you can see here flags and pennants and symmetrical triangles and ascending triangles and descending triangles. In other words, you have roughly 20 different formations, and you can click on each one of these and actually see the presentation for each one of them. And these are probably the major formations. 95% of technicians will use 95% of the time these 25 configurations or chart patterns. So if you're familiar with this, you'll be understanding at least 95% of tech talk. Alright, let's move on and see if we have anything else. Alright, so scroll up a little bit. Well, all I did here is save this page for you coming out of Wikipedia. You see, from Wikipedia, the free encyclopedia, technical analysis. Again, I'm not going to spend time to read for you. You're literate, assume. So, you see, you have general description, read some of the history so you know what it is. You see some of the principles of technical analysis, market action, you know, prices move in trends, history tends to repeat itself. I mean, these are some of the things I've been explaining. Of course, I've been using them from different sources, but this is a good beginning. Criticism, lack of evidence, inconsistency, you see what is the industry, use of technical analysis, and if you scroll down a little bit, you see the contents come, you see some of the head and shoulders, price, volume, etc. So, this is a decent material that you could read and educate yourself without having to purchase a book, alright? So, I think we're done with this whole Internet Explorer. You can close the whole Internet Explorer, close tabs. Yes, so what I have done for you, if you want to click on Applied Charts underneath here, is I have prepared for you, number one, the theory, which is what we've been doing so far, probably a lecture and a half. Now, applied charts is, I have downloaded for you and saved, I don't know, maybe 30 or so charts, which I have found and downloaded from different websites as I read articles on the internet and say, oh, this is a great chart for my course, so I save it in a separate folder. I have put them in here and I'm going to be showing you quite a bit. I'm going to be talking, this is, let's call it the applied part, maybe for another 2 lectures over these, and many of these, they have shown you some indicators. These may be old, 6 months, 8 months, or even 12 months. And then I created a separate folder over here called Chart Updates, where some of these charts, you can see them again from the last month or 2. In other words, updated most likely somewhere in 2008, and actually see what really happened. Alright, so this is the introduction to this. Probably we're going to spend 2 lectures, maybe more, maybe less, but that's the heart of technical analysis. So let's get back to this one here. Now, occasionally you can click on the plus sign down there and it's going to magnify a little bit. Not necessary to do for all of them, only those that are not easy to see. So, what you have here, and let's try to do this, is I've never explained so far moving averages. So, a moving average is simply the average for the last so many days, and it is shown on the chart. So, a 200-day moving average will be for the last 200 days. It just shows you what the average is. Then you may have, as it is the blue line, MA50. MA stands for moving average. So we have a 50-day moving average. This means you take the last 50 days and you take the average. For the next day, you take the last 50 days again. It works like dropping the 51st day and putting in the last day. So that's how it works. So this process of taking a moving average is known in time series analysis as smoothing. So when you take 50 days and then again, you provide averaging, and the longer the averaging process, the smoother the line. Alright, so if you just take a 2-day moving average, it's going to be zipping up very wildly. If you take a 5-year moving average, it's going to move very, very slowly. So, technicians are trying to make it not too short like 2 days because it's practically worthless, but not too long either. So, what they've done is they've tried for thousands of stocks, thousands of different lengths, and they have come up as a consensus that 2 of them are more useful than others. I might even say 3 of them are more useful than others. For the long-term cyclical analysis, the 200-day moving average seems to work the best and seems to be the most reliable. For the intermediate trend, the moving average, 50-day moving average, seems to work best. And if you listen to some of the recordings that I gave you on your exam when the guy was saying that he's made a 250-week moving average, this is good for long-term, multi-decadal secular trends. So 50 days for intermediate, 200 days for a long-term or cyclical, and 200-week or 250-week for a secular trend. Question?
How about less than 50-day moving average, for example, 25?
Well, you may use now. Remember, what I said was 50 was for intermediate. Some traders use 9-day moving average for short-term swings. Again, what I'm still presenting here is getting closer to the intermediate and cyclical analysis rather than short-term or swing trading. So, some technicians like 9 days, other technicians like 13 days. Maybe someone will have found 25 days. That's the one thing. The second thing to be very careful about is that these are not perfect numbers. Some markets may require a little longer. Other markets may require a little shorter. For example, with currencies, you'll see that currencies and dollar don't behave quite like it. You use it, but you think a little bit differently. I'll be showing them today and the next couple of times. So, moving average means that the following. If the 200-day moving average is moving upwards, that's number one, and the price is above the moving average, then you are in an uptrend. So, you had an uptrend line, that's one indicator of a bull trend. The 200-day moving average, moving higher and higher, jointly with the price above it, is a confirmation or yet another indicator that you're in a bull trend. Of course, the logic goes mirror-wise. If the 200-day moving average goes down and the price is underneath, then you're in a downtrend. Moreover, if you're really in a bull trend, what you will be seeing is that the price is above the 50-day and the 50-day is above the 200-day, then you're in a strong bull trend. So that's one way to think about it. What else do I have to show here? Well, not much. Let's scroll on the next one. That's it. Next image. Okay, next image is sometimes some authors like to put certain averages, and you can see how the averages move. Now, do you see, you are asking me, the guy is drawing an 8-day moving average. So, this is an illustration, for course purposes, how zigzaggy and volatile the blue line, which is the 8-day moving average. Of course, it may have indicators for super short-term trading, maybe taking a position for 2 days or for 5 days, but otherwise it is not as helpful. Then you have the red line, which is 13 days. You can see how the blue line is very zigzaggy, but the 13-day is a lot smoother. And if you go any further, you'll see this one here, this green line, which is MA200, you can see is so much smoother. So, this is an illustration that the longer the MA period, the smoother the line, and again, for this, you guys don't need econometrics. You need common sense and a good observant eye. Alright, let's move on to the next one and see what we have here. Alright, so this is USB, dollar USB. So you can see guys, you can read up top there and probably can zoom in. 30-year US Treasury Bond Price Index. So what you're looking here is, again, this you should be very careful, is not only simple technical analysis, but part of our cyclical analysis. So I'll probably get this chart back on cyclical analysis because it shows something very important. You have a base here in 1984. So if you zoom in here, this is 1984, and you can scroll down all the way to 2006, and up until recently this trend line was not violated. So long term, this is a perfect example of a secular trend. Bottoming here in 84. Well, it may have bottomed further down in, in 80 or 82 was another bottom. But what you see here is a 20-year trend line. There has been some violation over there. So over there at the top, you see some violation of the trend line. And the question is this going to be a secular shift in the trend, or will it continue? Well, we can see, we can pull it up. not today, not now. We can pull it up and get some modern charts. So probably in my last lecture of technical analysis, I'll show you 10, 20 or 30 charts in real time, meaning data up to the current date for which we pull it up. So this could be one of the most important charts you look at for years. What it's telling you, you got 20 plus years of an uptrend. Well, bull markets end. Remember when I was explaining to you, that's very important part of cyclical and secular analysis, is that gold peaked in 1980 and gold was moving down for 21 years. And at the same time, bonds were moving up. So what you have here for a 20-year period, real assets, gold, oil, etc. go down, and financial assets go up. So this is a secular phase of the cycle where financial assets move in one direction and and real assets move in the other direction. So if you're going to be making secular analysis, we're going to be interested when this secular trend ends and the new shift begins. When it begins and it's a secular, it must be lasting for 5, 6, 10, maybe 20, maybe 25 years. Alright, let's see what else we have here. Well, you see again, same stuff as here. You have an oversold condition, fairly cheap, close to the support line. You have one here, you have a nice buying point here, you have a nice buying point here. This is another good buying point, but with a danger. It has broken down, and if it's broken down, it might not hold. Alright, let's scroll further down. Okay, so this is an example. What's AG standing for? Silver, yes, that's how you have it in that Mendeleev table, right? That's how you have it. So, silver is here compared with Dow Jones Industrial Average. So, what you have here is, let me see how they've done. They've probably done a relative trend of the two. So, silver has been, and here is 19's got to be 88, and silver has bottomed out somewhere here in 2001. And what you see here is a 12-year downtrend. What you see here is guys showing you here a base. And the trend is violated and silver is moving on the upside. Let's move on to some other charts. Again, all I've done is taken it from the internet. Some technician has drawn it this way. Alright, this is one of the more important charts for my other course. But of course you got to understand it. This is a fairly cyclical chart. Let's say relatively long term, because we got a 30 or 50 year charts of the dollar. So what you have here is an uptrend, up. So somewhere around 2001, mid 2001, the dollar peaked. It hit the trend channel, and from there the dollar has been going. So it found a strong support here, it found a strong support here, it went down here. So once you're on the upside of the channel, you expect it to keep going down and down. Now notice that here the dollar is at 80. We will see some updates. The dollar broke down further and further. Alright, let's see what next we got. Okay, so gold-silver ratio. So, another very important tool that technicians like to use in general is to take ratios. Ratios show something phenomenally simple. Relative prices of two assets. They might be relative prices of real assets. They might be relative prices of financial assets. They might be relative price of a real and financial assets. When it comes to technicians, for example, in analyzing real estate, which will be a decent part in this course, they like to take real estate, which is a hard asset, not in dollar, yen, or any other paper currency, they like to compare real estate with some other hard asset like gold or silver. So you can actually draw, because you have excellent records of, let's say, real estate, meaning houses in Rome and in the Roman Empire, with the Byzantine Empire, moving on to British and moving on to American today empire. So you can get easily 2,000 years of prices of real estate in gold and silver terms. Are these prices going up or down or staying flat? What do you think?
In gold?
Yes, in gold terms.
Probably almost flat.
Yes, perfectly flat. For 2 years, real estate prices did not go up in terms of gold or in terms of silver. So, if somebody tells you real estate prices go up in the long term, this is nonsense. They never do, alright? There is no way you have a built house and somehow it will increase its value. Of course, the price in dollars or the price in level or the price in euro will go up simply because level, euro, dollars are losing value. But just because the currency is losing value doesn't mean that the asset itself is gaining value when measured against some other hard currency. Well, hard currency could just use wheat and measure it against wheat, and the answer should be practically the same when you measure a house, average house, for a bushel of wheat 2,000 years ago and today. So, what technicians like in this case have done is gold to silver ratio. In other words, precious metal experts would not mind at some point to be in gold and at some points to switch in silver. Actually, when they feel that they would want to be definitely in precious metals, okay? That's one's clear, at least since 2000 or 2001. So what they want to do is identify, and through these channels they do, at what point gold is relatively more expensive to silver, so they sell part of their gold positions and buy some of their silver, and vice versa. Note here that there is no portfolio analysis, there is no portfolio argument. They adjust their portfolio, meaning the percentage of gold and the percentage of silver within their portfolio entirely based on technical indicators, alright? So what you see here, there has been an uptrend. You see here strengthening, meaning relative strengthening of silver to gold, and that strengthening has weakened recently, meaning over the last 6 months. It has reached the top, and now the expectation is to go further down. So let's go next chart and see what we have here. Alright, so this is the chart that I was talking about, first or second lecture, doesn't matter. Gold, you see, it was in 76, mid-76 was close to $100. It nicely increased 8 times, almost 8 times, from $100 to up to $850, 8 times in roughly 3 short years. You also see this vertical line here. This vertical line here indicates a bubble. Vertical line indicates some sort of a mania, and it indicates that dumb money is rushing in. Another way to think about it is that, see, there has been a major pullback in 75. So, gold has gone down during the bull market. Remember, gold is starting at $35 when Nixon cuts it off from the dollar. So from 35, it makes a nice run, it makes a correction 73, 74, it makes a second run up to 200, it makes a second correction. This is a fairly lengthy correction of a year and a half. So this represents a cyclical correction. And this cyclical correction separates out phase 2 from phase 3. So now you have the herd, dumb money, rushing in and going into a spiral. And then you see how they're looking at it in different charts and whatnot. This is a very popular formation, which I was explaining before, called rounded bottom. Sometimes a bowl, sometimes a saucer. So gold bottom down. And another technical indicator which is clear is that there has been one bottom here in 99. There's been a second bottom here in 2001. This is called, logically, a double bottom. So you got yourself here a double bottom. So double bottoms are more reliable than a single bottom. Triple bottoms are considered to be most reliable. Of course, once you get a double bottom, you don't know if it's going to come back to the bottom for a third time, but at least you have a confirmation here, or a thesis, that the 20-year secular bear market, which began in January of 80, ended in 99 or in 2000. Well, it may have ended in 99, it may be in 2000. You're asking, well, which one it was from the previous course. Well, we may just point 2000 itself, because it depends. Are we going to pick this point, or we're going to pick gold relative to Dow Jones? If you pick gold relative to Dow Jones, because the meaningful way to pick a secular shift between real assets and financial assets is to take the ratio of the two prices. So only gold to Dow Jones or Dow Jones to gold ratio will tell you what is the bottom, will give you more meaningful. Alright, let's scroll further down and see what else we got. Alright, so what this one is showing you here, it is the same chart again. It shows you that 79 on the US dollar index represents a major support. There probably will be another chart which will go back many years, like 2 or 3 decades further down, and 80, 79 will represent a major support. So 80 was considered the big number. And the big discussion here was, is the dollar going to break down through 80? And if it does, it's probably going to collapse fast to this lower part of the technical channel. It is going to bounce off for a meaningful rally, maybe intermediate rally, and then slide back again. Notice that this is 2007. Notice also something else. Many of the charts I borrowed from goldmoney.com. This is the website of James Turk. James Turk is phenomenally competent guy in fundamentals, monetary theory, monetary history, but also a superb technician. So, at least a third or a quarter of my charts I've borrowed from Gold Money, because they are done very professionally. Alright, let's move on to the next chart and see what we got here. Alright, so what we have here is now taking the 30-year gold chart. We're zooming in from 2001. We're zooming to close to, early 2007. You see, you have a nice trend channel, number one. You also see a nice 200-day moving average. You also see that the 200-day moving average at some point touches the trend channel. And you also see at some point up there that there was a major breakout, or that gold ran away from its trend line. What else should we notice? We should notice that once it ran away in 2006, it had a major correction for 6 or 7 months. It had a second run up there. It had a second correction coming. And that second correction would indicate that phase 1 is over. And that phase 2 has begun. How do we know phase 2 has begun? We read the Wall Street Journal. We did it last time. Wall Street Journal is telling us that the second phase is on. It doesn't tell us the second phase. We interpret it as such. Alright, let's move on and see what else we got. How much time we got? 10 minutes? 10 minutes. Alright, so Now you see silver. Again, silver bottomed out right around here, 2002. Remember, silver early on up until 2003 lagged gold. Lag means that the gold-silver ratio was moving higher 4 charts ago, right? So now you see silver made a meaningful bottom here around $4. It made a major run up here. You see now a triangle. You see this triangle represents a major consolidation, the first triangle. And you also see that once it broke out of the triangle on the upside, it went all the way to 15. So this second triangle is another. Remember, this is an ascending triangle. It is horizontal here, and it is upward sloping or ascending out of the base. So when it moves up, it moves on the upside, it breaks out, it confirms the uptrend. So what you see here is within a secular trend, silver doubled here from 2003 to 2004. It delivered nice 100% return, and then it delivered nothing for almost 2 years. This is very typical of bull markets. Bull markets is important to understand. 70% of the time do nothing. 10% of the time correct on the downside and correct painfully, and barely 20% of the time move up. But when they move explosively. So you have an explosive move over here in 3 short months. Here you have a phenomenal explosive move in 5 or 6 months. Then you see silver does nothing. Does nothing means it consolidates. In other words, it's called it digests its gains. So silver has been digesting for for a year and a half, almost 2 years. Just recently, see this second line out there over 15. Just recently, a couple of months ago, silver broke out of that second support level and made another run at 17. And that's how it works. Alright, let's see what else we got. Again, coming from Gold Money, James Turk. Alright, so spot New York gold. So this now zooms in to show us a little bit more detail. First of all is the rounding bottom. Second of all is right over here is the double bottom. It just provides a better vision. The red one I would guess, yes, it's actually, don't have to guess, it's actually written, 200-day moving average. So, what is very important to see, I already explained it theoretically, let me now show you in practice. From 97 all the way to 99, the actual price was going down. The 200-day moving average red line was also going down. The price was underneath. So you have in concert all indicators are telling you you are in a bear market. So this is a nice cyclical bear market from roughly 96 to roughly 99. Over here you have a major spike on the way up. It forms an important technical level. So these lines are known as technical levels. At some point they represent resistance, at the next point they represent the support, and then it drifted again. Bank of England sold here. Gordon Brown proved to be the most incompetent money manager in the world. He sold a couple of billion of gold at the lowest possible price. Now they're counting his losses because this guy sold most of Bank of England's and Great Britain's gold, which has been accumulated for 300 or 400 years at the rock bottom price. If someone sold at the lowest price in 20 years, this is Gordon Brown himself. That's how he became a finance minister, right? That's right. And now prime minister. He was at that time the finance minister. All right, so back to technicals. This is a triangle. It is not an ascending, it is not a descending. This green formation here is a triangle. It shows a consolidation. So you have a run-up here, consolidation. Another run-up, consolidation. Notice something else. Over here in 2001, somewhere in the middle of 2001, finally gold went up above its 200-day moving average, and it has been staying ever since. Minor violation here, minor violation there, but you see the explosive move again from 2005 to 2006. Gold almost doubled, from 400 all the way to 700 or 800. Again, yet another triangle for consolidation and possibly a mini breakout in there. Let's move on to the next chart. Alright, so silver. Spot New York Daily Silver, what do we get in here? Well, what you get here is a major support line, a major resistance line. This is an extraordinary spike in 97, 98. It represents the recognition that silver is getting scarce and a great investment, and a great investor loads up tons, more like hundreds of tons of silver. Warren Buffett, he purchases 150 million ounces of silver during that period, and one buyer, one man, 150 ounces of silver drives price from 4 to 7.5. Well, then the price subsides, and you can see again bottoming here. You can also see that it's doing nothing. In other words, silver went up from $1.29 or so in 1970 to $45. It went up more than 30 times. If it went up more than 30 times and a bear market, secular bear market ensued for 20 years, over here from 94 to 2001, silver is doing nothing. It just digests its losses, and it prepares that strong hands are taking it, like Warren Buffett's strong hands. Well, he recently proved not to be so strong, but he was cheated out of his silver. I don't want to get into that recently. So you see now one consolidation triangle. You see a second consolidation triangle. You see that here, somewhere in here, silver began to stay most of the time above its 200-day moving average. So it confirms a bull trend. Let's see what's next. Oh, this is copper. Well, similar story for copper. Of course, the picture is different, but the philosophy is the same. You have a fairly downtrend. This here, of course, with here represents a double bottom. Copper, like many other commodities, peaked in late 1979, in January 1980. So for 20 years, copper has been in a bear market. But check this out. Copper was, if you bought in here in 2003, roughly at 50 or so, 60. Copper went to 360, 370. It went up 6 times. Wall Street will never tell you buy copper here. You'll never hear that. Alright? They'll tell you buy Dow Jones, buy NASDAQ, buy Google. Copper did infinitely better, okay? They just don't tell you these things. Now, the other thing to see is see how the 200-day is being moving down. I gotta see, probably this could be weekly or actually monthly. But once you see here moving decisively above this moving average, you know you're in a strong bull market. So you have a major bull run here, and then you have in 2006 major consolidation. Now it's even higher. Let's move on and see what we get. Well, we're about done. All right. Copper again. Well, let me see what we're trying to see here. Is this the same chart? All right. Let's try to do one last piece. Is see how it's going down underneath. And now you have this moving up. The other indicator, remember the difference between these two, is over here. So once this is moving up, and also these bars are moving up, these bars we call the MACD. It's for 12, 26, 9, you'll get to see them. So these bars are moving up, you're in a strong bull trend. Here the chart is monthly. Monthly charts are usually the preferred way to do long-term, meaning cyclical and secular analysis. Are you guys happy for today? So note where we are reached for today, so that next time we'll pick it up from here. So we're at copper GIF, alright? Alright, let's pause. You have